All right. Good morning, ladies and gentlemen. Uh, I think now we are in the right position to continue with where we have left off in our cycle 2.1 CPD. In this cycle 2.2 CPD, we're going to be dealing with volume 7 again and continuing with chapter 1 and chapter 2. Perhaps let us make it a point that we remind you that the first session was all about the introduction, where we were trying to tell you the things that we're going to take into account, the things that we're going to talk about. Perhaps before I can even start getting into today's menu, I have received quite uh, um, a number of questions from most small business practitioners who were saying, Mr. Buzane, we are confusing us because our understanding is that we are not preparing financial statements, and we can see that the gist of volume 7 is about the directors, the amount of work the directors must do to meet the expectation of the other users of financial statements. Let me correct that right there. The reality is that in the small businesses, you will find that the small business practitioner will go out and source or outsource the accounting function to somebody else. That person is normally called an accountant. Then that person will be doing the finance affairs of the business. However, that does not separate the small business practitioner from his duties, because remember, when that happens, the accountant gets the information from the small business practitioner. Do you get it? So it is the responsibility of the small business practitioner to do the financial statements, and outsourcing the financial statements to an accountant does not mean that that function is no longer yours. That is your function. In fact, it's how you intend doing it, because in a natural sense of the word, you should be employing an accountant in your business. But because you don't have enough money, you go and outsource these services. And by so doing, it doesn't mean they are not yours. So whatever the accountant does on the financial statements, you remain responsible for the ultimate product of what the accountant does. So what we're trying to do in small businesses, in small business practitioners of South Africa, the so-called SBPSA, is to make the small business practitioners understand what information must be there for them to give it to the accountant, how the information is produced, how the information is kept, and how the information is disseminated. The accountant has got the duty also to use exactly that information and nothing else. And if there's information that he cannot find for him to use, he must go back to the small business practitioner and say, look, I'm looking for this information for me to complete this. Please supply this information for me. So combining both the accountants and the small business practitioners in one compartment, we are trying to make information easier so that the small business practitioner cannot say at the end, I was not aware. So we're trying to create an awareness to say, what is it exactly that must happen, and how is that, after the financial statements have been prepared, affects the broader users of financial statements. So let us kill it in our minds, the fact to think that small business practitioners are not responsible for the preparation of financial statements. In fact, they are the ultimate people who should be preparing financial statements. Accountants are just helping them. But what we're trying to do is to combine these two people in one room and teach them or train them what must be done to come up with the final product. Okay, I think I've managed to take that out of the way. We are now clear who's responsible for what and why someone else is coming in to assist, who is being assisted, who has got an ultimate duty to do the financial statements. I think that that part is almost easier. Now, yesterday, I met a number of accountants very excited about this program and very excited to say, hey, we're happy to have an institution that is helping us to explain these things to our clients. Because when you are employed by a client and you get conflicted sometimes to explain some of the things, because it sometimes feel as if you want this because you want to increase the installment or the payment of accounting fees. Okay, I'm excited that you feel that way, and I'm hopeful that the education is gonna go on, is gonna live longer, and is gonna find penetration. Thank you so much, ladies and gentlemen. Thank you for those. I thought I should take those out of the way before I continue with chapter 1 and chapter 2 today. All right. So what we have done in cycle 2.1, we introduced the users of financial statements, and we mentioned those users of financial statements. We also mentioned yesterday that these are not the only users of financial statements. But for a generic purpose financial statements, we are able to identify at least 10 users. In that 10, there are auditors, but we are not going to be dealing with auditors in this series because we already mentioned yesterday that the auditors are dealt with in a separate volume altogether, which is volume 3 and volume 14 and 15. Who are those users? We identified the shareholders of the shareholders and investments as the ultimate users, who are the givers of capital. We also talked about lenders of borrowed capital, who are the financiers, banks, loan sharks, other financial institutions. We talked about suppliers of goods and services, those people who are giving you electricity, those people who are giving you printer, those people who are giving you internet, those people who are giving you telephone, those people who are giving you Wi-Fi, and so forth. Those people who are giving you trading stock, those people who are giving you packaging material, those are normally called suppliers. We also talked about other users who are the company employees and unions. We also talked about government and regulators. We also talked about customers. We also talked about competitors of the company. We also talked about members of the community, the people who are situated together with the company. And we talked about the directors. We did mention yesterday that the shareholders and the directors, together with government, those one will have the financial statements. It's a must. But all others, they get financial statements voluntarily because they got to find them, or you have given them because there's something that you want from them. All right. So those are the users that we have spoken about. Then we went to the background. In the background, we realized that in a company, you can find that the company, there is only a director. In other words, only a director and only a shareholder. In other words, in that company, the shareholders have created the company and gave it to the directors to operate, or the shareholders just bought a stake from other shareholders or from other directors. Or we talked about the situation where the director is also the shareholder of the company. Well, we must state that in some instances you will find that some of the shareholders are not the directors, but some of the, let's say there are 5 people who are starting the company. Then 2 of them agree to also be part of, to be directors, but 3 of them decide to say no, we just want to do something else. We don't want to be involved in the operations of the company. We're happy that you guys are there, so we're not gonna be involved in those in that company. All right. Although we're talking about, let me mention that although we're talking about the directors of the company, shareholders of the company, we must remember that we also have entities like sole traders or sole proprietors. We also have entities like partnerships. We also have entities like close corporations. And they are also included in this same situation because they don't have separate users. Once financial statements are produced, and once a business has been started, these people becomes the ultimate beneficiaries of the document that you will ultimately produce. All right. Then we talked on the shareholders about the three aspects of financial statements. We talked about the interconnected knowledge, and we talked about practical application, and we talked about varying depth. So we said there are two primary issues that needs to be considered when we're talking about shareholders and investors. We talked about what are the shareholders' primary concerns and what are their key financial indicators when they are looking at the financial statements. Perhaps I must also mention here that the preparation of financial statements starts at the beginning of the financial year. Let us stop thinking that the financial statements are only going to be prepared later. But when we open a new year, we've started to operate. We've started to do financial statements because that's where most of the things go wrong. Is to postpone the issue and think that it only belongs just after the year end. Once we stop doing that, we'll realize the benefits of studying the financial statements early. And would like to encourage you to do your financial statements as you open the financial year. Then we talk about lenders and financiers. We distinguished between what is unsecured loan and a secured loan. But at the end of it, we both agreed that there is no unsecured loan. We talked about instances when the financial credit history of the shareholders or the directors will be required when you are making an application from the lenders to get finances. We talked about sureties and we talked about guarantees. We talked about the difference between the two and we talked about the dangers that are coming with those two. We talked about the suppliers, we talked about their interest in the income statement, and we talked about how they analyze the balance sheet. We talked about their interest on the cash flow evaluation, and we talked about the need, why they would want you to come up with payment references. Further to that, we talked about employees as another group of users of financial statements. We talked about what employees are really concerned about when they are looking at the financial statements. And we talked about the union's interest on the financial statements. When we talked about government, we talked first about the South African Revenue South African Revenue Service, and we split that into two. We talked about the registration, and we talked about the submission, and we talked about the debt. Now, I just want to talk quickly, and we talked about the Department of Labor, and we talked about the CIPC. So I just want to quickly run through the SARS issue that I want. Uh, Here is SARS. So it is important when you have a business to make sure that it has been registered for SARS. So if your business is a juristic person, normally your business would register what we call an ITR 14. And if you operate your business as a sole proprietor, it means that you will be registering an income tax which is called ITR 12. So there are also instances where you become a provisional taxpayer, especially when you are a sole proprietor and when you are a juristic person. So it's an automatic registration that you become a provisional taxpayer. If you employ someone or if you take money from the business as a salary, you need to register your company for employees tax. So it comes in two categories. It will be EMP 201. This one you close it every month, and EMP 501 you close it in May, every time in May. So the provisional tax is always closed 6 months after the year end and 6 months after the first 6 months. Then there might be instances where you qualify for VAT and you register for VAT. Then, depending on the VAT category you are in, you will register for VAT 201, which is submitted depending on the category you are in. We want to advise that don't just enjoy the status of not being a VAT vendor. use what we call an SMRS to track your VAT registration. So the SMRS is a document where you put all the money that you receive, the money that you invoice, and it builds it up and it tells you whether you can now register for VAT or not. All right, so that you avoid penalties from SARS. So it is very important that you register on time and you register as and when you are required. Once you are a registered person for income tax purposes or SARS purposes, make sure that you understand the deadline so that you understand the information for each deadline. So you need to take note of the information that is required to fulfill each deadline for each of these tax types. All right. You must understand your tax types broadly. In other words, you must understand what are we talking about when we're talking about income tax. Maybe I forgot to mention here that the provisional tax and the employees tax are members of the income tax. So these are both income tax, but it's just a way to make income tax return easier. So SARS has broken down the income tax into two, that is the provisional tax and the employees tax. All right. So you must understand the information that is required for these tax types for you to submit and meet your deadlines on time. So you must understand your tax broadly, your tax stuff broadly. In other words, your accountant and yourself must have a session where he makes you understand what is value added tax and what is it for, where they are making you understand the provisional tax and what is it for and how to prepare for it, and the employees tax, what is it for and how to prepare for it. So those are the important things that you must understand when we are understanding your tax broadly. Then you must submit your provisional tax 6 months after the year end. That is the first provisional tax. And you must submit the second provisional tax at year end. You must not forget to close your employees tax before the 7th of every month. In other words, if you employ myself now, let's say the date today is 1 January 2025, you employ me and you tell me that, okay, you're going to be salaried at the end of every month. So employees tax says on the 7th of February, you must close the EMP 201 for January. All right, that's what we are trying to say there. Then value added tax, depending on the tax period, it is closed on the 25th of the following, on the month following the VAT period. In other words, if you are in 1 month period, your 1 month period, so let's take the same example. You have done the VAT for January 2025, then it means that your VAT return must be submitted to SARS on or before the 25th of February the following year. So when you submit, you must make sure that you submit timely and you must submit accurately. In the event you have got a debt, you must understand your debt and you must understand where your debt is coming from so that you can initiate paying on time. You must pay the right amount. If you can't pay, talk to SARS to make an arrangement. So there, when you're making an arrangement, you will need the financial statements for the previous year. You will need the management account. Let me explain the management account. So if your year end starts if your financial year starts from January to December, all right, so you will have your financial statements for that period. So the management account starts um, complete the period which the financial statements cannot cover. What do I mean? So if you apply for an arrangement to SARS, let's say in June 2025, and you already have the set of financial statements for 2024, so you would not have had financial statements for 2025 because you have not completed 2025. So the period 1 January 2025 to June 2025, it's when you're gonna make your management accounts. Let me now talk about cash flow projections. So because you have not ended the year, you are 6 months through and you cannot do financial statements for the 6 months, uh, and you cannot do management accounts for the next 6 months. You do what we call project cash flow projection for the 6 months ahead. Then you come up with your budget to say for the year 2025, this is my budget, this is how I was intending to spend, this is how much I have spent. If there are deviations, these are the causes of deviations. So let me talk a little bit about paying on time. There is an error that is done here. Normally, when once you register for any of these tax types, there are calculations that the accountant will have to do and submit to you as a small business practitioner. So, but what we have picked up is that most accountants don't bother themselves by making a tax calculation of any form. They just go to the system and close the information for the client. That is wrong. Remember, the accountant is employed by the small business practitioner. So, whatever the case is, before you submit the information to the system, you must make the small business practitioner aware of what you're gonna submit and the implications of what you're gonna submit. For instance, if you are submitting an income tax return, or you are submitting a provisional tax, or you are submitting employees tax, or you are submitting value added tax, we should remember to say, now that I'm submitting, you're gonna owe SARS 120,000 rand. All right. And so that the client is able to emotionally prepare for that one, than for the client to realize later that he owes SARS 120,000 rand for something that it was not explained to. All right. So the client must be aware. So by the time the debt arrangement is done, the client is already aware that you have spoken with him about this amount to be owed to SARS, and you have given the client enough time to gather the amount, or for the client to understand where to find the amount, than to take the client on surprise. Remember, you still need to be paid by the client, so you must help the client to find ways to deal with the issue there. All right. Now, the second, okay, let me just clarify this issue of financial statements once more. So, the financial statements are for the previous period, that is 1 January 2024 to December 2024. Now, today it's June, let's say today is the 30th of June. So, there are no financial statements. We can only do financial statements maybe in January 2026. So how do we cover the period 1 January 2025 to 30th June? We will need to prepare management accounts, which by the way are prepared on a monthly basis. Now, what are we going to do with the period that is still outstanding in the financial period? That is 1 July to 31st December 2025. That period is going to be covered by cash flow projections. As the year starts, what we should have done between the month of January and February, we should have completed a budget to say this is how the business is going to operate, these are the expenses that we're going to incur, and this is how we're going to realize profit or losses, and these are the reasons for us to do that. So those ones are the documents that will be required, that should always be available before you can start of thinking of making a payment arrangement with SARS. Okay, so we encourage the small business practitioners to take note of that, and we encourage the accountants or financial records clerk to help the small business practitioners in that regard. All right, let us now go to the Department of Labor. So with the Department of Labor, we now that you are the director of the company, we should upfront determine what is your director's remuneration. We might want to register you for provisional taxpayer, especially where you don't have a fixed salary. So provisional tax payment must be registered. All right. So from the director's remuneration, we should calculate the UIF for the employer. We also need to calculate the UIF from the employee's side. We must also consider if there are any fringe benefits. I just want to talk about this part of fringe benefits. With the small businesses, especially with the attorneys, the legal practice professionals, you become an accountant for that entity. Then when the time is right, you are asked to prepare financial statements. You prepare the financial statements. You discuss the financial statements with the small business practitioner. Then everything is well and good. Then the small business practitioner takes the financial statements of the business and go to Volvo and buy a Volvo X60 there. So what Volvo will do, they will register that Volvo X60 in the name of the business. All right. So now that Volvo becomes the asset of the company. So it needs to go to the asset register. We need to calculate depreciation from there. So when you're calculating depreciation from there, it reduces the profits of the company. When the Volvo has got a problem or repairs, we deduct it from the what the company makes. When there are repairs that needs to be made, tires, lost keys, and all those things, we deduct from the revenues the company makes. Now, what has been the confusion is whether this Volvo must be included in the payee of the director. The answer is yes. So the tax the director pays must include the use of the company car, that is the Volvo. Also, we've seen instances where the director will use the same financial statement and buy property, maybe buy property in Santin. All right, so that property is a property of the company, even though it might not depreciate, will be kept as an investment property, but staying in the company property should attract employee benefits. So when we're calculating pay as you earn, we must also take into account the Volvo and the house. So we should be careful when we're dealing with those things there, and it should not be a worry. There is also what we call a director's loan. We have seen many financial statements with director's loan. We're gonna have a separate section where we are dealing with employee benefits and where we are dealing with director's loan. But we won't be dealing it under the small business platform. We're gonna be dealing with those under the tax platform. All right. So we have to identify the employees. The same thing needs to happen. There is also what we need to consider as COIDA and invoicing. So COIDA is similar to EMP 501. These are normally closed during the month of May in the following year. So we must make a correct calculation of COID for the director, and we must make a correct calculation for the employees of the business. But perhaps if I can just mention, it's dangerous to calculate COID at year end because you may understate your expenses. The best thing to do is to calculate your COID per month, because you find that there are employees that are joining in sometime during the year. There are employees that were there at the beginning of the year, and some of the employees are not there. But if you compound your COID month to month to say, okay, here are the employees that were here this month, the month of January, let me calculate my COID. You calculate your COID and you put it aside. Then when you go to February, you do the same thing like that, and you add up those. So you will more or less have a good amount of accuracy in your financial statements. All right. There is still a battle in the small business environment, looking at the what is said by the national minimum wage. So there is also what we call the skills development levy. So what we are encouraging small business practitioners to do, they must build this skills development qualification. So in other words, there must be a way of determining whether you qualify for skills development levy or not, all right? So that you avoid SARS imposing penalties to you and say, look, you have qualified for skills development levy long time ago, but you have not been paying it. So here is amount that you owe us, and here is the penalty in which you need to pay. So we need to avoid that. There is also what we have seen where you find inspectors from the Department of Labor coming to visit your office unexpectedly and comment about your safety regulations. Okay, there are also instances within the Department of Labor where they will want audited financial statements. It is very important that we deal with volume 3 and volume 14 and 15 in this regard so that we can deal with the process of getting audited financial statements. So they won't only ask for audited financial statements. So what we've seen is that they also want the EMP 501 and the EMP 502s for the whole year. All right. So it is important that you stay prepared. You always have those documents. But my worry with the Department of Labor is that even if you can produce these documents instantaneously, they take forever to complete what they need to do, and they don't assign a specific person whom you're gonna contact on a regular basis. You need to go through the call center. Sometimes you call, nobody picks up the phone, or sometimes the phone is picked up and hanged again, and all those things. So it's quite chaotic. So just try to avoid instances where you're gonna deal with the Department of Labor, or be prepared to deal with that nightmare. And what also is interesting is that unlike SARS, where the small business practitioner may give you a power of attorney to go and visit SARS on his or her behalf, there's nothing like that with the Department of Labor. So Department of Labor will want the owner of the company to come without the assistance of the FIP. Okay, then you've got the CIPC as another regulator. So CIPC is interested on the annual returns. The annual returns are closed on the anniversary date of the business registration. In other words, if you register your company on the 1st of January, you get your CK on the 1st of January. So it means on the 29th of December every year, you will have to close your annual returns. There's been a confusion that you cannot close annual returns without financial statements. We want to clarify that the SMRS is the document that records your revenue per month, and it builds your revenue as you go through the year. So with the help of the SMRS, I don't know where is it now. With the help of the SMRS, here it is. With the help of the SMRS, you will be able to close your CIPC annual return. So you don't need the financial statements. So, and what is nice is that let me just do this. So what is nice about the SMRS is that it's normally done together with the management accounts. Yeah. So even if you don't have the SMRS, but the management accounts should suffice in getting the annual return, the Section 33 of the Companies Act out of the way. Then you've got the customers. Customers are interested in reliability assessment, and they are also looking at the going concern of the business to say, will this company still be there when we need it in the future? And they are also interested on the quality of the products that you are issuing. That is what you sell. What is the strength of what you sell, and what are the weaknesses? When we talk about weaknesses, they are also looking to say, looking at your product and someone else's products, can they still rely on the product in your product with the weaknesses it has? Then they are also looking at the response capacity to say, when they are talking to you, how much time do you take to respond to them, and what is the quality of your response? Then there are competitors. Competitors are just looking at your financial statements to assess the weaknesses and strength of the competitors. They are also very good and at taking hearsay to say what's going on in your company and capitalize with that. So competitors are very good in that. So we also have members of the community. They are interested in three categories in your financial statements to say how is the production of what you are selling affects the environment, and how is your company employing locally, and what investment are you doing company in which you to the community in which your company is situated. Then there are directors and management of the company. These are interested in financial statements for two things: for strategic decision making, in other words, to ensure that they comply with all the rules and regulations and with all the laws and accounting standards in ensuring that they meet the expectations of these people. And in doing so, they must make sure that they do that by complying to their fiduciary duties, and that's all. It's quite a lot of work that the directors are faced with. So it's important for us to tell you that when you get into business, you must understand the amount of responsibilities that you are faced with and the decisions that you are about to take. Hence, small business practitioners of South Africa exist. We exist mainly to help you to go through in that regard. So what we're going to be dealing with now is cycle 2.2 CPD. And in that cycle 2.2 CPD, we're going to be getting into some detail as to the shareholders and to the lenders of capital. Now, I just want to take a step back and say, here is Mr. Vuzane wants to start Kunoka Chartered Accountants. All right. So Mr. Vuzane must decide whether he wants to start this business and run it. So in that case, I will be the shareholder and the director. Or I want to start Kunoka Chartered Accountants. I have the idea of what must be done, but I want somebody else to do that. So if I'm doing that, I will only be the shareholder, but I won't be the director of the company. So the person who's gonna run the business, whom we call him the director of the company, that person must understand that he has got the duty to prepare financial statements at the end that will meet the needs of these people. And those financial statements are called generic financial statements. He is part of the people who will use the financial statements, but the added advantage to the directors is that they are also in the advantage of preparing the financial statements. So they also work with accountants and auditors in the preparation of financial statements. Yes, the auditors won't be preparing the financial statements if they are not employed to do that. They will be auditing the financial statements. Let us take this out of the way. It is possible that you engage an auditing firm, a group of auditors to prepare the financial statements. They can do that for you, but they cannot audit the financial statements that they have prepared. So you will need to go and find someone else who, who will come and audit the financial statements. We understand what is happening in the small business environment where auditors would create other companies and use those companies to prepare financial statements and them audit those financials. That arrangement is not a problem in as much as there's a clear separation between who is doing the accounting work and who is doing the accounting work and which team is involved in both of these teams. So we thought we should take that out of the way. We have, it's just that I don't remember which volume that is. Well, I think it's volume 11, where we are talking about the directors and all what comes with that portfolio, and where we're talking about shareholders. I think it's volume 11, but I will have to look. But there is a point where we talk about those people. All right. Now let us get to it. Now, chapter one, this is a continuation of CPD, cycle 2 CPD. So this is now volume 2.2, cycle 2.2 CPD. Maybe we should point it out that the analysis that the shareholders now are going to make in the financial statement may help the directors to look on things better. This is an advantage in a situation where there's a separation between the directors and the shareholders, because the reality is that when the directors are also the shareholders, the analysis is completely different and it's biased. It's biased on the sense that the shareholders are also getting a remuneration as directors. Okay, the analysis that is gonna follow is the analysis that is done when there's a separation between the two of them. All right, we have found that the directors who are separate from the company analyze financial statements differently compared to directors who are also the shareholders of the company. All right. Now, having said that, let us now get into the understanding of financial statements for shareholders. So, there is no doubt that financial statements are a critical tool that provides shareholders with the insight into the company's performance. They want to understand how is the company performing in terms of the income statement. They want to understand the value the company is bringing in terms of the statement of changes in the equity. And also, they want to find out what are the future prospects, that is, the income statement, the balance sheet, and the cash flow of the business. In this way, with this presentation, we're trying to explore what shareholders need to know when reviewing financial statements. We are trying to assist the shareholders, small business shareholders, on how to interpret key information and what metrics matter most for their investment decisions. Perhaps we need to remind ourselves that you don't just, we have explained in the cycle 2.1 CPT that there's a process of becoming a shareholder, and you must be clear in your mind how you have become a shareholder of this business. Whatever the case is, whenever the case is, always have a share certificate that proves your shareholding in the business. And for you to have a valid and an authentic share certificate, you must visit our website and register yourself there for a share certificate and hold on to that share certificate. The nice thing is that SPPSA will send the share certificate to your email address, and the share certificate is based on what you say to us. We don't dispute it. We just create the share certificate based on what you are saying. All right. So when you become a shareholder, it means that you have shares in the business. All right. So what? Let me just take a step back and go back to a situation that I've just explained yesterday. Let me explain it again. You ask a business consultant to create a company for you. Konoka Chartered Accountants. The business is created. You're getting the feedback that here is the company, here is the CK, and that information is explained to you. So the company is rated. When you page on the last page of the CK, you see your name there. You are written there as a director. Well, you are also the shareholder, even though you are not written there as a shareholder. Now, in fact, you are not yet the shareholder, hence your name is not there. All right. Now, when the company is born, when the company is registered, it's either it's coming up with 1,000 shares or it's coming up with shares, with 100 shares. Those shares are authorized, not issued. It comes up with authorized shares. These are the shares that it has. All right. So the shares belong to the company at that particular moment. So you have to buy the shares from the company. So you can buy the shares in a number of ways. You can take a loan to buy the shares of the company. You can use the money that you have from the bank account to buy the shares of the company. You can use your time, your skill to buy the shares of the company. You can take an asset. For instance, I can take the printer that I've been using here at home and give it to the company and say I'm buying shares. But what is also important is for us to understand this. The company is going to come with 1,000 shares authorized, or is going to come with 100 shares authorized. When you buy shares, it is important for us to understand how many shares you are buying. And when you buy that number of shares, you must make a certificate with the SPPSA that tells us that exactly. In other words, if you are buying all the shares, if I'm using this machine to buy all the shares of the company, my share certificate will gonna come with 100 shares. But if I say no, I'm gonna buy 10% of the shares, so I'm only owning 10% of the company. If I'm the only one, I'm owning 10%, but I'm the only shareholder of the company. So there's no issue there. So if I want to buy more shares, I can go back and say, okay, now I've got 50,000 rand I want to put in the company. I'm buying again a certain number of shares. At each time you buy shares of the company, the share value must be determined to say, when you bought the shares with the printer, they were 20 cents. All right, so you bought so many shares. But when you bought the shares again for 50,000 rand, this was the value of the share in the company, so that you are able to track so that you are able to understand how much value of the shares you have in the company. All right, but let us not confuse this. You still have sole shareholding in the company, so you are still the only one. So if for instance you die, all right, there's a difference when we deal with somebody who was owning 100% of the shares or all the shares of the business, and there's a difference when we're looking on someone to say, no, out of the share issued, the person only bought 50 or 20 shares, so we're going to deal with that differently. So now that you are a shareholder of the business, you own shares in the business, you have the shares. Hence, you've got the share certificate. So to you, the shares are an asset and you are expecting your asset to grow, all right? Hence, you are interested in the statement of changes in equity to say how are your shares are growing, all right? So if you are a shareholder only, you are entitled to dividends. So you are entitled to two things. You're entitled to the growth in the shares and you are entitled to dividends. However, if you are also a director, you are interested in a salary as well or a director's remuneration, so you are benefiting three times. Okay, so irrespective of who you are, the fact that you are the shareholder, you want to know how are the dividends gonna grow in future? Will you be paid your dividends in future or not? Will the dividend amount be the same? Will the dividend amount be reduced? And if the dividend amount is increased, what effort has been done to increase it? If the dividend amount is reduced, why the dividends are now being reduced? Now, you can also decide to sell all of your shares, in other words, to sell your business to someone else or to sell part of it. All right. Remember, I said when I started, you may have bought 100% of the shares. So those shares are yours. They are not from a business point of view. So when you sell your shares, you will say, okay, from the shares that I have at Kunok, I'm selling 50%, so the payment is coming to you. But if you only own 25% at Kunoka and Kunoka is selling the other 25% to someone else, then that payment for that 25% does not come to you, it goes to Kunoka. All right, so we should be able to deal with those. So you are deciding at this moment to say, how many shares should I sell uh, from me, okay, from the business? So that is what you decide there. Okay, so you must always have a share certificate that is talking about your shares, that describes exactly how much value you have in the company. There are normally disputes that we've seen where people will claim that no, this is my company, this is not my company. So the share certificate can come in handy there. But it's not any share certificate that is doing that. It's the share certificate that is done by Unoka CPT. I mean, which is done by Small Business Practitioners of South Africa. Because when you do a share certificate, then you don't ask someone else to do it for you. even if you ask that person is gonna do that certificate with you, all right, because there are questions that the person must answer, all right, which you know, all right. So if you don't have a share certificate in your business, visit our website and do your share certificate there. Okay, so we have already talked about how you acquire shares. You can buy shares from your own money. You can exchange an asset. You can exchange for services. You can use a loan to do that. All right. So that's it in this particular slide. All right. Now, here are the sorry. Here are the directors of the. I mean, here are the shareholders of the company. So what we see here is that we have a direct shareholding, and we've got external shareholding, and we've already explained that the director shareholders is a director who is also a shareholder of the company. So these guys, the director shareholders, they are interested. In fact, they have interest in three things in the company, and we've explained that. And we said they are going to get a salary. They are also interested on the business growth, and they are going to get dividends. Then you've got external shareholders. With the external shareholders, you're going to get, they get two things. They get the business value or business deterioration, and they also get the dividends only. So hence you find most people become director and shareholders. It's because they own, they are interested in three things rather than two things. Okay. If we deal if we deal with director shareholding, okay, uh, so these are the people who are involved in the growth of the business. So they work to grow the business themselves. Okay. One of the advantage for the director shareholders is that they've got quick access to cash. All right, as the cash gets in, they are able to utilize it for their purposes, but account for it properly on the books of account. They become aware and they understand the business broader compared to the external shareholders. And remember the okay, I'm gonna deal with that later on. Okay, so they earn a salary as well whilst they are growing the company, and they've got no one else to blame if the company fails because they were part of that one. All right, they do not always combine salaries and dividends. In other words, even though they are entitled to dividends, the director shareholders, when we look on the financial statements and when we prepare the financial statements, we normally don't get to a situation where we can pinpoint a situation where they have declared dividends for themselves. Okay, so when we look on external shareholders, we've already outlined the their entitlements, that they are entitled to two things. They are entitled mostly to dividends and the growth of the company. They normally don't have quick access to the cash that is inside the business because they are outside the business. They don't even know if there is cash. And normally it takes longer for them to understand the business. Hence, you'll find that the directors sometimes lie to the shareholders because and they accept that lie because they don't understand what is going on there. And of course, they cannot earn a salary because they are not employed in the business. And when the business fails, external shareholders can easily blame the directors for that. They are only entitled to the dividends. Okay. Okay, it's always easier to buy an existing business for them because they are not involved in the operations. But sometimes the decisions to buy a business, it's not always well informed, all right, because they do not understand what is happening inside. Okay, so they might not get an early indication of what economic factors are affecting the business. So when you get to business as a shareholder, you may want to understand the following information to say, who am I? For instance, myself, I started Kunoka Chartered Accountants, so I am the shareholder. But I'm also running Kunoka Chartered Accountants, so I'm the director, shareholder. All right. So that one is out of the way. So because I'm the shareholder, I need to understand my responsibilities. But because I'm also a director, I need to understand the director's responsibilities within the company. And because I'm salaried, I must understand my relationship as an employee of the company as well. I must understand how the deadlines that come with these responsibilities to say, as the director, I've got these responsibilities, and this is how to execute these duties, and this is when I should have done with all of this. One of the things that I need to remember is that what is my financial year? When does my financial year end, start, and ends? Who else needs the information that I'm about to deal with? I've already outlined in this session who are the users of financial information. Okay, so where in the financial statements will I get the information that relates to all the users of financial statements? So if I'm a shareholder, where should I look to satisfy my needs? If I'm a director, where should I look to satisfy my needs? If I'm a supplier, where should I look to satisfy the supplier's needs? Okay, I just want to go back a little bit here and talk about these users of financial statements just to clarify an important point. Mr. Vuzane has started a firm called Konoka Chartered Accountants. He's also running that firm. All right. So Mr. Vuzane is the shareholder and investor to Konoka Chartered Accountants. Now, because he's also running the firm, he also becomes the director of the firm. Because he's also paying UIF and paying COID, he becomes what the employee of the business. Can you see that this is one person? Now, Mr. Vuzane decides that, hey, I need money to buy burglar proofs for my office because in the area we're experiencing a lot of burglary. He goes to Standard Bank to look for a loan. Standard Bank gives him a loan of 45,000 to do that. Then Standard Bank becomes a lender to Kunoka. A company comes to Kunoka and say, guys, we want tax opinion, we want a tax advice. Can you do our tax returns? Then Kunoka becomes a supplier to that customer. Kunoka realizes that they want burglar proof, then they become a customer to the person who's going to be doing burglar proof. There are a lot of other chartered accountants around where Kunoka operates, so Kunoka has got competition. Around here, where we are operating, the municipalities have demarcated those into wards. We are in Ward 7 in Mthatha. So in Ward 7, there are businesses, there are households, there are schools, there are municipality grounds and facilities, there are open fields, there are golf courses, there are taxi rank, there are people who are selling. So Kunoka is becoming a member of that community. So can you see now how these people are linked together and are intertwined? I thought perhaps let me just clarify that so that you understand it broadly. Now, what message is in these financial information that I want to find? The message the shareholder wants to find is the growth of the shares, current dividends, the future dividends, and whether the growth of the business necessitates me to sell my shares. Now, I'm also interested to find out who is in the production of the financial statements. How qualified the person who's doing the financial statements for me? Because the quality of financial statements is very important that I may make a mistake because of the errors that are in the financial statements. the quality of the financial statements can make me make a good decision because of their quality. So I might also, when I'm looking on the financial statements, decide on what is affecting my shareholding and the things that go with. What are the things that go with my shareholding? Are the dividends if I'm an external shareholder, but if I'm a director shareholder, is my salary, my dividends, and the value of my shares. So you can see now that the shareholders of the business have got far much more greater interest than anyone else on the information that is on the financial statement. It is then the responsibility of the SPPSA to train the accountants, to train the small business practitioners to say, for us to get into accurate financial reporting, these are the steps that we need to follow. These are the things that we need to do. This is when do we need to do these things. And this is the person who needs to do this at this particular moment for this particular reason. All right. So I think now it now gets better to understand why all these these stakeholders are important in this regard. What are the shareholders looking for? They are looking for profitability. Maybe if we deal with profitability, we just have to explain it. Profitability is a product of two things. Is a product of sales and is a product of expenses. Just 1 minute for that. Is a product of sales and is a product of profitability. Perhaps if you are in the services rendered, you are not selling good, it's a product of services rendered, the value of services rendered, and the expenses. So how do we get into profit? We get into profit by saying sales minus expenses. Now, the assumption there is that the sales are more than expenses. Let me make an example. A company makes a total sales of 10 rands. It incurs expenses of 5 rand. So sales is 10 rand, expenses is 5 rand. So the profit there is 5 rand. Sales minus expenses 5 rand. Let us change it. This year, the company makes the profit of, makes sales of 5 rand, but incurs 10 rand. So there's no profit there. All right. So the company is reporting a 5 rand loss. So it is very important that when we deal with sales, SPPSA has created a method of making sure that the sales are correct. So we call those accurately determined sales. So we've got a method of accurately determining the sale. Okay, because remember, if you are a VAT vendor, your sale will also go and affect your VAT returns. All right, so it's going to be a chaotic exercise if that is not managed properly. Then we've got a method of determining expenses. All right. So we called those carefully determined expenses. Okay, let me just go back. We've got sales. SPPSA says here is the formula to accurately determine sales. All right. Then you've got expenses. SPPSA says here is the formula to carefully determine the expenses. All right. So we have already, so when you've got profit where your sales exceeds your expenses, the value of your shareholding is increasing. But if you're having a loss at any particular stage, the value of your shareholding decreases by the amount of the loss. All right. So within the small business environment, there is a big challenge with determining the accurate revenue and carefully determining expenses. We want to take that out of the way. We want to take that out of the way for the benefit of the users of financial statements. We want to produce the financial statements that we know that the amount of work and the amount of consideration that have been done in these financial statements worth noting. All right. So there is also risk assessment. the liabilities, as the more your liabilities are growing up, the more the risks for the shareholders, because it means that the shareholders are losing control. We don't know who are we owing, and we don't know the strength of the person we are owing. We don't know for what good reason we are owing this person, and we do not even know whether the liabilities are yielding. What do I mean when I say the liability is yielding? Let us say um, I went to Standard Bank to take a loan of 50,000 rand to secure my premises because I wanted all the windows to be burglared. Now the I took the loan. The loan goes to the balance sheet. So in the balance sheet, I've got a 50,000 rand I need to pay back within 18 months, and it has got an interest of 2,350 per month. That is fine. The shareholders are not worried about that. They are only worried to say, is this loan yielding? In other words, was the purpose of taking the loan working? Now, have I stopped getting burglaries in my office? But if now I'm continuing getting burglaries, in other words, the burglaring system is weak, and the Tsotsis have found another way of getting into my office, and they are still stealing in the office. Maybe they are penetrating through the roof, or they've dug the hole and they are using that hole to get in. Chances are this liability of 50,000 rand is not yielding, because there is no protection. Things are still getting stolen. So shareholders are very worried for that. So when the directors are going to take a loan for the business, they must make sure that the loan has been thoroughly studied, and it's gonna do exactly what they are taking the loan for. Because Standard Bank enters nowhere on why they steal burglaries in the office. What they know is that they've given you the loan that you have wanted. How you have used it, they enter nowhere. So they want their capital amount together with interest for you to pay it. Remember, if you are paying an interest, you are reducing the profit of the business. So there is a value that you are taking away from the shareholders. And because this interest and the capital amount is going to be deducted is going to be deducted from the cash flow of the business, you are eroding the value of the company from that point of view. And combining the income statement and the balance sheet, and you are taking away money from those two components of financial statements, it means that the value of the shareholders is going down. So shareholders are very worried about that. Then there are contingent liabilities, where somebody is suing you, or has noticed you that he wants to sue you for a particular amount, but the amount has not been confirmed for a number of reasons. Maybe the process is still going to court. So it's an indication to the shareholders that the business is going to lose more money. All right. However, what we are saying is that it is important to collect all your contingent liabilities together with your contingent assets and group them together, because you will find that maybe you've got a counterclaim to that person. The person is always is wants to sue you for 100,000 rand, but you know that you can sue him for 500,000 rand. So, but if you add those together, you will find that the shareholders will be happy to know that whatever the case is, there is gonna be a creation of value for themselves. When we add the total liabilities that we have, we add the assets that we have, we add the contingent liabilities, we add the contingent assets of the business, then that can more or less tell us about the going concern status of the business. And that is how the risk assessment by the shareholders is done. However, it means that the directors must be honest in disclosing these two, and it means that the directors must tell the accountant who's going to produce the financial statements about these instances. The accountant must have a checklist to get this information from the directors of the company, and the accountant must report these things efficiently on the financial statement. So you can see that it's a whole long process that must be done just to make sure that the information is accurate enough in the financial statements. So the creation of financial statements is not just an easy exercise. There is a lot of work that must be done there to ensure that there is enough information about the state of affairs of the company, and there is enough information for the users of financial statements to make a decision there. So we've already pointed out that the profitability is sitting on the income statement, yet the risk assessment is sitting on three components of financial statements. That is the income statement, the balance sheet, and the cash flow. However, the biggest component that is going to report the risk assessment of the entity is the statement of changes in equity. Then you've got the business value. We've already talked a lot about what is increasing the business value, or what is the business value. So the business value is stated in the statement of changes in equity. So assets minus liabilities, it's what is normally the business value. But we should also make you remember that even though you can easily determine the business value in this regard, there are also a number of factors that may increase or decrease the business value as you have determined it from the equity statement. So we're going to deal with those as we deal with other users of financial statements to see how do they see the business value, because you can have a business that is doing very well, but you find that people want to buy it with a very little amount, and they put forward their reasons for that. Hence, you'll find that there is a midpoint when we're doing a company evaluation. We evaluate the company based on who wants to sell it, and then we evaluate the business based on who wants to buy it. Then we take the midpoint. In other words, we take these two sides and we divide them by two and say, here is the value of the company. There are a lot of factors that are taken into account when we are buying a business. So lot of factors, in the sense that there are qualitative factors and there are quantitative factors. So the amount that we find in the statement of changes in equity will fall within the quantitative side. But also there are other factors that we need now to take into account to validate the amount that is in the statement of changes in equity, or to invalidate those into that amount. However, each factor that is in the qualitative side doesn't go freely. There is a point, or there is a value that is given there. So that value, that point that is given in that, the value that is given in that point carries some form of weight, which will either increase or decrease the value of the business. So shareholders are very interested to know these things, and they should be given information that is going to help them to do that. uh, One of the components is the cash flow statement. The cash flow statement is the statement that is going to tell us whether the business will be able to meet our future dividends, why the current dividend is not being paid, and what is the impact of the operational needs of the business. So what we've seen is that shareholders are very much interested on the company that is reducing the operational expenses, because if you are reducing the operational expenses and you are focusing on efficiency, it means that you are opening up more funds to be distributed to the shareholders. So you will find that the shareholders frown a lot to a company that is increasing or spending exorbitantly on items that are not necessary, because they understand that this company is trying to reduce what is what is due to the shareholders. You would have seen that there are instances where, when you look at the budget, you find that no, this company is making a lot of money, and because of this, the company is in a good shape, all right. So it's not gonna need the excess money that is sitting on its balance sheet, so it wants to give it back to the shareholders in a form of dividends. That is one form of giving back money. But what other companies will do, they will say, okay, Mr. Vuzane and Mr. A and Mr. U are owning this company. They each have 33%, 33%, 33% in this company. Let us reduce their shareholding, because if we are reducing their shareholding, we are reducing their dividend expectation, we are reducing their business growth expectation, we are reducing their shareholding expectation. So instead of giving these guys dividends, but they rather buy shares that they have from the company. Well, there are companies act regulations for that, but it's something that can still happen. So the going concern of the business, if we're looking on the risk assessment, we find that it has got an impact on the value of the business. It can threaten the dividend, the current dividend. It can threaten even the future dividends. Okay, it can also erode the amount that has been injected to the company. It may also cause reputational damage. So these are the issues that the shareholders must be aware of when they look on the financial statements and when they are looking at the management at large. So these are the things that they will be looking to see. Now, here is the analysis of the profit performance in the income statement. You will see that the for the year the revenue that the company has made, it's 11 million, all right. But the profit that is reported at the end of the year is 360,000 rand. So you can see from what we get from the financial statements that almost 10,640,000 goes away. So the shareholders will be interested to say who is taking 10 million rand, because from this we can see that the shareholders are only left with 360,000 rand, and it's not possible that they were gonna get that 360, all of it. All right. So they will be interested to say, all right, who is taking the majority of the amount from that 10,640,000, and there are calculations to do that. It is possible that with the amount that is remaining, there might be no dividend. It is possible there is no certainty also whether the 10 million rand, the 11 million rand was all cash. Okay. Although there is no certainty, but it sometimes provides a relief to the shareholders to say, okay, the 10 million rand was combined, was a mix of both cash and accruals. Okay, but they will want to know how much was cash and how much of that 360 was cash. Then it can justify how much dividend it's going to them. Even though the company has done well, for instance, in 2013, in 2023, the company made a profit, a revenue of 3 million, and this year is making a revenue of 11 million rand. So there's a big jump. But look at the profit. This year, the company is making a profit of 360,000 rand with a revenue of 11 million. Last year, the company made a revenue of 3 million with a profit of 405,000. Can you see that? Let us assume that this company was trading on cash basis. It means that the dividend that could have been paid out in 2023 was going to be higher in 2023 compared to 2024, even though it was going to be. What is an irony is that it could have been higher with revenue of 3 million, but it's lower with revenue of 11 million. Shareholders will frown to this and say, what is going on with this company? What is really happening? Especially when they've ascertained that this both of these revenue, the revenue of 11 million and the revenue of 3 million in the previous year was both cash. So they will want to understand what the management is doing to increase the profit, what rooms are made available to make more cash, and what constitute this large discrepancy between these 2 years. Where did the money go? One of the things that we might find out in this company is that there is a lot of information that has not been reported. However, if the information has been reported, the chances are there is a lot of information that is not true that was done to balance the books. So we have to be careful on this, and the shareholders will pick up that. All right. So we've already dealt with issues like is the revenue all cash? Did the management pay all the expenses? Okay. Because you will assume that with the revenue of 11 million, CIPC has been paid, SARS has been paid, the Department of Labor has been paid. If the employees belong to a certain fund, the fund has been paid. Okay? So they are interested to find out if the revenue covered all the regulatory expenses. And if the answer is no, it then strengthens the feeling that where did the money go? So does the money only exist in paper, or does the amount also exist in the bank account? Well, so far we're looking on the performance of the entity. We don't know what is sitting on the cash flow. So what is important now is for us to understand how is the statement of financial position, the statement of financial performance talking to the cash flow, because it can really brew up the angry between the directors and the shareholders, because it could mean that there's a lot of information that is not here. And in these instances, you will realize that it's only when something like this happens when the shareholders are going to ask the company to be audited, because they want now to get into the bottom of what is really happening. So if the company had cash revenues of 11 million and it had a net profit of 360,000 rand, the directors would want to know what are the implications of this, especially when there are instances where the regulators like CIPC, SARS, DOL have not been paid. They are worried now because it means that if they are not have been paid and the company has made so much money, it means the taxes are growing. And if the tax is growing and is not paid, and is attracting interest, it's attracting penalties, and those interest and penalties are going to eat from the income statement. And if they're eating from their income statement, they are eroding the company value, and they are worried about that. They are going to be more worried because there is also interest from the Department of Labor. And also they are going to be worried, especially when there is more than one tax type. So it means that if the company is registered for VAT, is registered for provisional tax, is registered for employees tax, it means each of those three tax types will gonna come up with a penalty and interest, which is eating more from the directors. Imagine having and interest from income tax, interest from employees tax, interest from provisional tax, interest from value added tax. It means that the company is not doing well, and immediate intervention has to be done. Fine. In that 11 million, the shareholders will also want to know, since the company is registered for VAT, did did the company appropriately exclude VAT in that 11 million, or that 11 million also have VAT? So these are the issues that the shareholders will be looking into and say the company must make immediate turn to solve these issues. All right. Some of the issues that are pertinent here is that the shareholders might not want now to get the financial statements only at year end. They might now see a need to say, okay, report to us twice, report on the interim and report to us at year end, because they see that there is something that is not going well. And if they sit and fold their arms, something is gonna go very sour to this company. So you can see now that the shareholders are no longer happy about what is happening, and there are reasons for them not to not to be happy. While both scenarios show profit, situation 2 demonstrates significantly better position with the same sales but lower expenditure, resulting in higher profit margin. That is debatable, because if you are looking at the sales for 2023, they were 3,200,000. Look at the profit that was registered in 2023, it was 405,000. Look at the sales that are produced in 2024, they are 11 million. But look at the profit that is produced, it's 360,000 rand. That is ridiculous. So where is the money? So shareholders will prefer that the company must go back and look on the accuracy of its reporting, the accuracy of its bookkeeping, the timing of reporting, and so forth. So, whilst the revenue was 11 million, which is far, far much more greater than what was happening in the previous year, it does not bring an absolute smile to the director. So directors are, I mean, shareholders are still worried, and that can really create tension between the directors and the shareholders of the company. So if we're looking at the business value assessment of the company, we can see that the total equity is formed up by share capital and the retained income of the business. This is a typical situation that you will find in a small business environment, because in the small business environment you don't have a greater detail of line items in the shareholders equity. So you will normally get these two. Sometimes they can be three, because you can want to separate the retained earnings from the previous year to the current year's profit. But the retained earnings and profit is the same thing. Then you've got shareholders equity, I mean share capital. But what we also seen is that with the small businesses, you get very little share capital. You'll find that the share capital hardly exceeds 5,000 rand. You'll find that it's normally 100 rand. It's no, it's and it's not, you don't even know how that 100 rand was determined, because one of the mistakes that we have seen is that, let us take Mr. Ndulini. Mr. Ndulini goes and open a company and the accountant charges him 450 to open a company. And the accountant takes that 100,000, and that 400 rand, and puts it as an equity of this. That is wrong, because that is not the amount the company got for selling the shares it has to Mr. Ndulini. So that must be corrected immediately. All right. So even if you ask the shareholder to say, or the directors, how did you arrive at this share capital, you won't get an answer. So we want to urge accountants to pay particular attention to the share capital of the business, because the share capital of the business determines the value of the business at a particular time. Let us say now you want to sell this company and it reflects a share capital of 100,000 of 100 rand. You can tell from that moment that you are not gonna get a lot of money, even if your company is doing well, because you've understated how much capital you've put into the company. Then you've got retained earnings of 392,911.37 cents. They are there. But in those retained earnings, we must also ascertain if we did not include the current year's profit. When we separate between the retained income itself and the profit, we are doing that to see what is the impact of every year to what we have already done. Because it can be an indication that, look, the time for your business is up. You must just let it go now and go and start something else. But it can also give a hopeful view that, look, in terms of what is on the paper and in terms of what I know the business is doing well, it's just a few things that needs to be done. Maybe that can be another reason to hold on to the business. So when you are adding up your profit, you are adding up your retained earnings, and you are adding up your share capital, you are getting your total equity. Now, even though that is your total equity, we should always remember the initial value that we have put into the business. In other words, how much investment we have taken up with this business. All right. So these are the things that the shareholders would want to know, because they are interested to find out if the business is going forward or is going backwards. And with the impact of profit on retained earnings, profit or loss, they also want to find out whether the business is going back, and if it's going back, at which speed is the business going back. Now, however, there are still a lot of factors to be taken into account if the shareholder wants to sell this business. For instance, now we know that this business came with 100 shares that were authorized, and 100 shares were issued. All right. So if 100 shares are issued and 100 shares are authorized, it means that the share capital, the share was sold by 1 rand, was the share capital is 1 rand now as we speak. So the total value in the total equity is 798. So if you want to sell this business today, we need to calculate the value of the share. The value of the share today is 798,834.45 divided by 100 shares. Okay. So when we do that, we get a value of each share to be 7,998 and 35 cents. Okay, depending on how many shares you want to sell. All right, so that is how much you can sell your shares. So that is not the value of the company shares. That is the value of your share in the company. Remember, in the previous slide, we have already talked about how do we separate between the value of the company shares and the value of your share to the company. So what we have picked up is that uh, many people and many accountants would normally confuse those two. If we look on the revenue generation analysis, we have already talked a lot there about the discrepancies, especially in the profit, the discrepancies on whether the amount was cash or was an accrual, to say how much of that amount will yield to dividends and how much of that amount will be given as a value of the business to the shareholders. All right. So we've picked up a number of things that one, when we looked at the revenue, and we realized that this is a services business, and the people who are involved here are primarily employees rather than the machinery. All right. Because we did not see any significant assets in the balance sheet. So hence we are able to make that statement to say, okay, the biggest investment here is on employees. All right. So we also find out from the income statement that there are no cost of sales, which tells us that this is a services rendered company. It's not producing anything. We also picked up from the income state, from the balance sheet, that there is no inventory, hence there are no cost of sales, and why we were happy with that. We saw that there is a high level amount of employee cost as shown in the income statement, and the shareholders were worried about that. Well, if the shareholders knew from the beginning that the company was gonna be labor intensive, this should not be a greater worry to them. But they were gonna be hopeful that over time the company will reduce the amount of labor and start to infuse in other technologies that will reduce the expenses of labor. All right. There are a number of reasons why now they are worried, because if the company started with a labor force of 100 employees and now there are 350 employees, the company starts to worry, because even if it started with 100 employees, it started like that in most instances because it knew that it cannot afford the machinery, so people can do the work. But over time, they were hoping that the company is going to reduce the amount of labor. Why they want the amount of labor to be reduced? There are a number of reasons for that. One of the reasons is it means that for the company there are more workplace safety costs. So as much as you pay your employees for their salaries. You also pay to the Department of Labor UIF. You also pay for the employer UIF. There are also employees tax that you are paying. You are also paying COIDA amount at a high value. You are also dealing with provisional tax and so forth. There is also a skills development levy that you are paying. There are also safety costs that are increasing. You will know that in South Africa there is a lot of attention that is put into labor. So the shareholders are not happy with this type of situation now. All right. So they understand the complexity of dealing with labor related laws. that they can be daunting. It means that senior management of the company are not spending much more time now taking the company forward, but they are sitting down dealing with company related issues. There might be employer and employee management administration's issues that may make it difficult to deal with all the employee related concerns. And you will know that when the employees are not happy, the production stops, the customers are affected, the suppliers are not paid on time. There are a lot of dissatisfaction rates within the company, and sometimes when people cannot strike and cannot listen to the absenteeism goes up, because they are it's not possible to think that the revenue of 11 million was done by the same labor force that was there in 2023. So there might have been some increases of labor force to get into that. And of course, now there are much more worries to say, is the company in good shape with employee records management? What happens when the files are getting lost, files cannot be found? What information was there? What frustration does that information brings to the owner of the company, the directors of the company, and the employees of the company? So if the company is having such a high level of expenses on labor with no corresponding increase on the asset, it means the company does not have a collateral to take further loans to finance its operation. There is no security, which puts so much pressure to the shareholders. Shareholders may not always have money or willing to bail out the company, and it puts more pressure to the directors to find other sources of money, which may lead to corruption. Um, the labor itself and the South African laws does not always help to stimulate production because there's too much rights that is given to the management. With this type of labor force, there are frequent and unending conflict management issues that we might find, and also with the amount of new staff members that have joined now in the last previous period that has made the 11 million, it means that training costs and awareness about human rights, about the jobs themselves, about how to do the job have increased. Issues and differences in gender, age, time of joining the force, the ability to do the job has also increased, which needs a lot of attention to the management. So shareholders, when they are looking at this situation, they are really starting to frown and starting to think more about the company. And they, although the revenue is increasing, they are worried to say, I wonder where is this company going. All right, so these are the issues that they are looking when they are looking at the revenue analysis. So if you look on the asset utilization, you find that the company had only 33,000 in terms of assets. And of course, we've already dealt with the issue that the company is relying a lot more on the employees. But there can be other issues or concerns that are raised by the shareholders in this instance. One might say that this cannot be correct. If there is so many employees, what tools of trade do they use to work? What are they using to work? Does that mean there is information that is not recorded in the financial statements? So, what are these employees doing if they don't have tools of trade? Okay, so what type of company is this? Because if you are employing someone and let us say the company has employed more administrative clerks. So what are they doing? Where is the computer? Where is the desk in which they are working? Where is the chair? Where is the kettle? Where is the fridge in the kitchen? Where is the internet? So someone might say it's not possible to have such an increase of revenue without a corresponding increase in assets, because then you must justify uh, what do these laborers do in their normal. Could this mean that there is poor reporting? Could this mean that there's a breakdown between the management of the company and the accounting function? uh, could it mean that the accounting function is not clear about the information they want from management? Could it mean that the management does not know when to give or what information to give to the accountants? Who is involved in the reporting, and how qualified that person is, and for how long that person has been dealing with reporting? Could it mean that we are seeing a breakdown between the accounting function and the management function? Is the management well vested with the importance of reporting, or they only want the reporting to be done when they want the financial statements? Could that notion be the one that is affecting what we see now? Because what we see does not make sense. Now, we can see that from last year, the financials, the current assets were 500 and were 500 and the last year the financial statements were 391, and this year they are 520. But when you look on the assets were 627, but now they are 300 and they are 33,000. So we don't know whether in these assets is there a director's loan and how the director's loan has been accounted for. We don't know whether it's because the director has paid back the loan if it was there, and whether that payment corresponds with the cash flow statements. In other words, if we see a decrease in the director's loan, can we go and track that decrease on the cash flow statement? Is that information there? If the assets have decreased so much, what was the situation between 2022 and 2023? Can this be because of the impairment? There are a lot of assets that have been impaired. Are the directors aware of that impairment? Could this be because of depreciation? Could it be because of disposal? Okay, has the depreciation amount changed on the income statement? Are there any assets that have been disposed by the company because they are no longer used? And where is the cash? All right. We did not see in the income statement any item that says profit from disposal of assets. We did not see anything in the income statement that was saying loss from disposal of assets. Okay. So if the current assets and non-current assets are behaving like this, are behaving in an opposite direction, of course, the shareholders will be interested to understand what is the situation when it comes to current liabilities and current and current non-current liabilities and current liabilities. Is the direction of the change the same one we see on the current assets and non-current assets? And if it's not the same one, what is causing that situation? And if it's the same, what is the best explanation to justify that? So you can see that if there is an increase in if increase in impairment, it means that whatever asset that was bought ate a lot from the shareholders' wealth than it had to give to the shareholders' wealth. So it means that we have to look precisely on what is causing the rise in employee cost, and whether what is done by the employee cost cannot be done by the machinery going forward, and if there can't be any investment that we are putting in place to ensure that we are reducing the employee cost. Maybe we are too focused on employee cost. Maybe there might be a need to go through, the shoulders may want to go through line by line expenses to make sense, because employee costs would not normally grow up by themselves. They may take some of the expenses with them. So when the employee costs grow up, the expectation is that there are other expenses that will grow up as well. For the service business, this is not often appropriate. Those shareholders should evaluate whether the return justifies the expenses. All right. So it's not wrong for the shareholders to ask these questions from the directors. The directors should be able to explain these variations, these variances, and these challenges to them, so that it is understandable how the company is moving, and what are the issues that are affecting the company. All right. But if we're looking at the cash position, we can see that the cash has done very well. The company had a bank overdraft of 2,966.38 cents in 2023, and in 2024 they've got a positive bank balance of 774,984. Now, if we compare this with the profit, because if you see here, profit is 360,000 rand. So it means that there were a lot of uh, expenses that were non-cash in the income statement, which gave us more. They've opened up more cash for us, which is a good thing. But we might want to understand whether the amount of 774 is sustainable. In other words, what is gonna be there in 2025, in 2026, in 2027? Can we find hope from that one? Can we deal with the non-cash items that are in the income statement, because they are also eroding the shareholders' wealth? Is there enough? Are there enough cash controls in the business to ensure that we stay in this place for a longest time? Is the amount available in the bank balance, in the bank, or the amount only exists in the bank alone? So by strengthening the cash management practices, we are making sure that we buy only when it is needed and only when the company is going to benefit from that one. So if we look at the liabilities also in the income statement, I mean in the balance sheet, one would ask, if the company has got cash of 774, why does it still have liabilities of this much? Or put differently, are these liabilities coming from the previous years to this year, or they have been accumulated because of the rise in revenue this year? Whatever the case is, what is the best way to keep the liabilities or to keep the cash together with the liabilities? Will that help the company at all? Or if we want to retain some form of cash within the business, what percentage of cash must discharge what percentage of liabilities? However, if we take out the current cash and we take out the current liabilities, we will be left with 5,957 rand. Will that 5,000 help us to do anything? Can we still keep the liabilities and do more with the cash that we have? But clearly we cannot give dividends back to the shareholders with this amount of cash against this amount of liabilities. Does the business budget? Maybe if the company uh, is doing budget, we can quickly look on the operational budget, employee budget, and the personal budget and see how much can we retain as cash to discharge some of the operational issues and discharge some of the liabilities, so that we don't carry forward some of these liabilities. Because if we continue holding on to these liabilities, the chances are we are also holding on to interest that comes with it, and therefore eroding the shareholders' wealth. So shareholders might be thinking of these things, and they might be asking these questions from the directors. So when we look on the balance sheet, we can see that the total assets that we've seen are 1,567,000, which is made up of total equity and total liabilities. The reality is that the when we take out the liabilities from the asset, we are getting a total value of 798, which we have explained. Now, it, whilst I understand what has been said there, to say the true value of the shareholders' equity is 798 when we are taking off the assets, we're still not sure about the quality of the assets, whether they can be bought with the value that we think it is. But whatever the case is, the 798 834.45 exceeds the initial investment that we have put forward of 500,000 rand, which gives us an amount of 298,834.45, which will be realized if we're selling this business. However, that is not the ultimate amount that we will get, because the amount that we will get will still need to go through the CGT. Yes, there could be other factors that we need to consider. We have already confirmed the assumptions into 798,834, that it can either go up or go down depending on who's making the valuer, and depending on what is the discrepancy between the selling value and the buying value. So the middle, or the midpoint, might be affected there. So SPPSA really helps with those calculations, with business valuation. The way we do valuation is different to our members, and is different to somebody who wants us to do a particular valuation at a particular point. So you can see that the shareholders are really, really frowning with this, and they are not happy about the amount of factors that are working on the negative than the amount of factors that are coming to the positive. So if we're looking at the ranking, investment ranking, so Mr. Nduleni is getting a business value of that amount. He still has a director's salary and is still entitled to dividends. But if he went to buy property, he would have 102,000 rand that is coming monthly, that is before tax, because remember, this amount is also after tax. All of these options have got their advantages and disadvantages. Um, Even though the biggest disadvantage here is to deal with expenses, and the another biggest advantage is to make sure that there is growing revenue. There are also disadvantages here, to deal with tenants. Tenants don't want to pay. Tenants don't want to answer their phones. When you get there, it's locked. And with the loss of eviction, because you cannot just evict someone there. The amount of fixed deposit of 17,500 rand a month, I'm not sure if this amount is per month or is per year. Otherwise, it's not a good indicator. We know that there is a law of risk and return trade-off, which states that the greater the risk is, the greater the return. So the risk here is greater, and we have seen that the return is good, because Mr. Ndulini is a dual shareholder. In other words, is a director shareholder. So he is entitled to the business value, the director's salary, and the dividends, even though we did not see the dividends in the business. What is important for the shareholder is that they should be able to see and calculate both returns and risks. So they must be able to see the opportunity to pay the dividends. They must be clear about the salary that they get, and they must understand what is making up their business value. All right. So this is the simplest way of getting into the business value. All right. We have already mentioned that this value can go down, or it can go up. To push the directors, some shareholders may state upfront how much they want of returns and at which particular point they want. So that can really create some problems between the shareholders, and because it puts more pressure on the directors. Some of the directors don't want that. They might sometimes think that the shareholders are now trying to bully them. However the case may be, the situation that we see demonstrates why business ownership can outperform passive investments despite higher risk. Not only despite higher risk, it also requires a lot of effort to be in business. It requires a lot of sacrifices, especially at a small business environment where nothing is certain, where the economy is down, where you need to pray for the customer and pray for somebody who's gonna pay the customer, so that the person, so the prayer is too long. You pray for that person to pay the customer, and you're praying the customer to pay you, because when you pray for that person, you don't know at which rank you are in with the customer. You may find that you are in rank number 5 with the customer, so he has got other people in front of you that needs urgent payment. And also, what I've picked up, customers at the small businesses don't pay because they understand the value of the product that you are giving them. They also pay depending on whether they feel you or not. You know, I've seen customers say, "Ah, man, lantwana yeke lantwana ukhohlakha siphinde siyibone, masibhatala ubani." Yabo, hey, and all those things. So those are the issues that you will find happening in the small business environment. So even though we can see that there are nice other returns like rental property and fixed, it looks like getting into business is still the right option, but it doesn't end there. There's a lot of effort that must be given to it, and there's a lot of understanding that must be given to it to for one to understand what exactly must be done there. Okay, external auditors, we've already mentioned that we will deal with this volume in volume 3, which is talking about auditing and accounting in South Africa. We will also deal with this in volume 15 and 14, which deals with auditing of small business in South Africa. Now, we have already talked and say there are instances where shareholders may want to rob in shareholders may want to rob in external auditors. This normally happens in this stage. Here, that doesn't happen frequently because the directors are involved in the business, so they understand what is causing this, what is not causing this. Here, the directors are not involved, so they might want to bring in external auditors to do some of the work. All right. So in instances where there's separation between directors and shareholders, we've seen shareholders also trying to use highly qualified accountants, especially when the business is doing well. They require that the company must employ good accountants. They also require that the company must employ financial records clerk, the guys who are doing N6 from TVET colleges. They also require that external auditors be employed. So they are trying to make sure that at least on a financial department, there are good controls. But even those are good controls, those are the controls that still report to management. Those are the controls that are employed and paid by management. They are not paid by the shareholders. So for the shareholders, they only put those controls in place and they are happy that the controls are there. But the reality of the matter is difficult to call those key controls or strengthened controls because they also depend to the directors of the company. So, so the external auditor is going to come there twice during interim and final to examine financial statements to ensure that these financial statements are correct. In other words, if we're saying sales are 11 million, indeed sales are for 11 million. If we're saying assets are for 33,000, we mean that those assets are for 33,000. So this part, the independent verification, is going to be dealt with in terms of volume 14 and 15. Then the audit report and all other supporting document that goes with it, they are gonna go. We're gonna deal with it when we're dealing with volume 3. All right. Then when we deal with the investor, the shareholder protection, the aim there is just to build confidence so that the shareholders are able to make informed decisions about what they get from the financial statements. So it's, as we mentioned before, we're not going to deal with this in depth. We just want to introduce to you to say, then you can see why the auditors become an important user of financial statements, because when auditors do their job, they also rely on the financial statements. Hence, on the cover page of the financial statements, you will pick up that the financial statements will tell you if they are audited or not. All right. So if the financial statements were not audited, you can easily tell that the auditors were not there. But if the financial statements indicate that they were audited, it means that the auditors were there. So what we will see in volume 3 is that the audit report is addressed to the shareholders. not the management. So there's a reason for that, because in this case, where the auditors are employed by shareholders, it is the shareholders who appoint the auditors. So it is important that it is addressed to them. However, even if there's a director shareholder relationship, the audit report is always directed to the shareholders, because the superior venue here is the shareholding venue than the director's venue there. Okay. So the depending on the audit report, as you will see, you will find out that the audit report confirms that things are going well or things are not going well. All right, that will pick up from the audit report that we are getting. All right, so there are different audit reports that we might find. Okay, so we will make the emphasis about this when we're dealing with it in volume 3 and in volume 14 and 15. All right. So the Small Business Practitioners of South Africa is a new entity that is meant to help us to comply and to understand our financial responsibilities. All right. So we play a critical role in improving financial statements preparation for small businesses. So we're very interested in educating people just from the start to the end. So shareholders and directors and businesses at large are encouraged to register with us. So what is important here are the services that we offer, that is the reporting and compliance guidelines. So with that one, we emphasize on the thorough document management, transaction management, proper and timely recording, uh, development of supporting documents, financial controls, distribution and management of business rules, and monitoring and evaluation. Then in the second part, the support for small business prosperity, we are looking on the financial growth of the business. We were looking on the administration growth of the business. Our aim there is that when you start a business as a small business, you must not end small. And you must be able to identify things that are bringing you down, and you must be able to identify things that are pushing your value up. So, in terms of advocacy and operational skills, what we're looking there is that do businesses validate learning through experiential learning, where in our platform you also have other people you that are in the small business, because once you join with us, we get you into the society where you share your problems with them without necessarily us helping you, but you learn from the experiences of other people. That's when you realize to say, yo, I thought my problem was better. I can see this person has got a bigger problem than me, and we work together to find solutions. So there are resources that are there in small businesses, but they are not always utilized. So we want to understand and make an appreciation of the available resources, understand what further resources are required, and how to use the resources that you have to move forward, and how to safeguard the resources that you have. So if we're looking on the key takeaways, we've looked at the financial performance, and the focus there was on profit, which was an income statement. We looked on the future outlook, the future dividends, the future prosperity of the business. We looked at what can affect the future prospects, that is the going concern of the business. We looked on the role of auditors, which will deal with it separately. We looked at the business value to say, how do we get to know how the business is doing, and whether the business has got a future potential or not. Then we evaluated our possibility of getting dividends and why we cannot get dividends. And we looked on the value of liabilities and their impact, and we saw how dangerous it is to have such a big value of liabilities in the business, and how we should manage liabilities. We also went further to understand the fact that sometimes it's not optional to get into liabilities. Circumstances force you to get into liabilities because you see the future of the company, you see the direction However, you don't know how to move forward other than the liability because nobody else is giving you the cash to move forward. We draw important attention to separation to say, is the amount that is reported as available in the business, can we go and find it there? So if we want a bank statement for that business, can we find the amount? Which now brings us to another point to say, does the business keep cash in its premises? And is that cash reported to the bank account? So when we're doing financial statements, are we only relying on the bank statement balance, or should we also ask a question about the petty cash that is sitting in the company premises, which now helps us to understand the role of the shareholders, what information they are looking for, where to get that information, how to prepare for that information. And now we're getting to a second user, which is called the lenders of the business. Now, here, lenders are critical financial stakeholders of the business. Now we know that because we know that this is normally the capital that we get from those people. Remember, when we started, we said there are many ways in which you can beef up the capital of the business. In other words, how you can acquire the shares of the business. So, when we're talking about financial lenders, we're talking about the loan that you're going to get from the bank. Whether the loan comes in the form of cash or the loan is going to come in a form of assets. In which way? Sometimes when you want an asset, some of the bank will say, no, we're not going to give you cash. We just tell us where the asset is. Then we're going to deposit the amount there for you to get the asset. That is still a loan. The loan is equal to what the bank would have given you had they given you cash. All right. So this is the amount that is going to be recorded in the current liability section. I mean, in the non-current liability section of your balance sheet. We normally go to the lenders when shareholders don't have to give us the money, or when they don't want to, or when they don't have the money. All right. So it's capital the provided by shareholders when they cannot. So in South Africa, you'll find that we've got two types of lenders. We've got lending that is coming from government and lending that is coming from financial institutions like bank, like individuals, and loan sharks. Okay, so these are essentially types of loan lenders. So the loan that we're getting here could either be secured or unsecured, depending on what the transaction is. So lenders lend money to grow the business. So they, depending on whether we call it security, secured loan or unsecured financing, there are many ways in which the loan might be secured. We might, for instance, take more interest to secure the loan. There might be assets that are used to do that in form of a collateral. There might be also mortgages that are used in form of fixed assets. Okay, so the lenders have got, when they're looking at your financial statements, they are asking themselves a number of questions. Sorry, one of the questions that they are asking themselves, sorry, one of the questions that they are asking themselves is that, will you be able, with the set of financial statements that you have produced to us, will you be able to pay will you be able to pay back the money in full? Will you be able to pay back the money on time? Will you be able to pay back the money in full on time with our interest? Will you be able to pay back the money without us having to put additional procedures in place that are costly to us? In other words, do we have to call you? How many times must we call you? Must we send someone there? Must we employ somebody who's going to follow up on you to pay us that amount? So those are the things that they consider, all right? And those factors, when they taken into account, they determine the rate in which you must be given. Because if they find that there might be problems in future with you, you'll find that your interest rate goes up, because the interest rate needs to deal specifically with the cost of giving you that loan. All right. So those are the things that even yourself you can do to find out if you are a good person to be given money or not. Even though we have outlined some of the reasons why shareholders may not give you money, but there are other factors that we might want to take into account. All right. Shareholders may not have sufficient funds available when capital is needed, because when you are running a business, sometimes a situation crops up and you realize that I need 100,000 rand to get over this hassle or this mountain. So shareholders might not have that money at that time, but may have it at some time in the future. Okay, so instead of getting the money from the shareholders, and which is gonna take longer, and which they might not have, or they are not willing to give you because they don't understand what you want to do, uh, taking a loan might be faster than to assemble shareholders into one place. Because remember, shareholders are not always in one place, and getting them in one place outside their normal routine can really be costly, and it might be time consuming for you. So we have known that taking a loan is cheaper than raising equity funds, because taking a loan is also interest deductible, and shareholders may not always want, and it's always difficult and tiring to beg shareholders to do this. All right. um, when you take a loan, we should also remember that you still have a responsibility to look at the debt to equity, because even though the shareholders don't want to give you the loan, it doesn't mean they are opening up the risk to the debt equity ratio. So when the lenders, remember, lenders have money only, but they are not content. They still want to grow that money, because they are in a business of growing money. So when they give you the 500,000 rand that you want, they are going to charge you interest. So that interest is going to go up and eat from your income statement. All right. Then the capital amount will have to reduce your assets in the balance sheet. And if it's reducing your assets, it's also reducing your business value. The capital amount together with interest, they're going to go to the cash flow and reduce the amount there. Depending on the term of the period, that position might stay with you longer. Hence, you must make sure that when you're taking a loan, you're taking a loan that is going to yield. We've already mentioned why or how you will see whether the loan is yielding or not. They can also list you on the credit bureau if you are not paying them on time, which might be a problem for you and the business, looking on the fact that as in some instances, when you're taking a loan, the loans financiers don't only do the credit worthiness check up with the company only, they will also do that with you as well. So if you are taking a secured loan, it might lock some of the assets. Even if there are good opportunities to dispose them, you might not have that. So they have got the deducting rights. They are deducting from the income statement, they are deducting from the balance sheet, they're deducting from the cash flow, and of course, they are deducting from the statement of changes in equity. In the case there are disputes between you and the lenders of financial statements, yeah, the consequences are really great, because if you are going to an upfront loan lender like bank, financial institutions, and all those things, those guys can employ highly competent lawyers who have been dealing with issues like this for a number of years, and and you won't have enough money to employ lawyers. So they've got that upper hand. If you go to take a loan from the loan sharks or mashonisa, yeah, those guys also employ uh, very, very competent people to get their money from you. Whether they're going to threaten you, or whether they're going to shoot you, or whether they are going to damage your car, or whether they are going to come to your house and take your furniture, it's highly impossible to think that you may compete with them. So loan lenders have got mixed ways of getting their money back from you. So when you want to take a loan, you must understand from where you are taking the loan. You must understand your responsibilities. You must be honest. You must be able to talk to them when you are unable to pay back the loan. You must make estimates. You must submit the new sets of records that dispose of your new current situation so that they can evaluate their position there on their side. Avoid not taking their calls, because if you do that, you are getting into more bad books with them. So it's a very tight situation, unlike what you would do if these were your shareholders. All right. So you must understand the impact of the loan. For instance, here, Mr. Nulini wanted to build a block of flats at a cost of 2 million to house 85 employees. Each employee will pay 7,000 rand a month deducted from their salaries. The project will take 3.5 time to complete. So you can see from here that the inflow will start happening after 3.5 years. So how will they service this loan between now and the 3.5 years? And when that happens, will it still have 85 employees at its workforce? All right. The nice thing is that the 7,000 rand is deducted before a final salary is paid. There will be a lot of issues if it was not doing that. Okay, so there are a couple of advantages here to say. Um, uh, so there's a couple of considerations that must be taken to say: do you go the loan route or do you go the shareholders route to finance this property? So if you look on how the banks evaluate the loan itself, you might sit down before you send your application to the bank and do these things yourself. So one of the things that you will need to have are the financial statements that are prepared in accordance with the SPPSA specifications. So the bank will want to know whether you'll be able to service the loan from the very first month, and looking at your income statement, they will want to understand what is the impact of the loan both on the financing and the operating activities. Taking into your loan the loan their loan to you, how will your projected cash flows look like going forward? Who are your customers? Where are your customers? What is the nature of the customers? What are the weaknesses of your customers? What is the strength of your customers? How is the general economy? Is okay? Is your customer government or individuals? Knowing that governments do not always prioritize paying small businesses, it might be a waste of time to give you money. However, individuals themselves are not always reliable. They've got other economic issues that they need to deal with. And what is the credit bureau report talking about you and the company as well? All right. Is there security for the company to give to the lenders in case it is required or it's used as a security before the loan is disbursed? What is the interest rate should be with your current credit status? If the company assets are insufficient for security, banks may want a personal balance sheet from the directors. Now, this is not normally an easy exercise as well, because depending on how you are married, your marriage regime may also impact that one. Because you might want to get into this, but because you are married in community of property, your spouse refuses to be part of that loan. So if your spouse does not want you to take the loan, so it means you cannot take that one. Some of the banks are specific to say, we understand, we have seen the financial statements that you are giving us. Please give us audited financial statements so that we can make our assessment on the information that has been audited. Now, there are a number of problems with that one, because the time the client comes to you and say, no, I want audited financial statements, and the time the bank wants to consider the period, it's normally very short. And some of the auditors will do the work properly and thorough, but they will need more money to be deposited first before they do the math. So loan applications can also increase operational cost. You can get into audit that might not give you the right audit report. And if the right audit report is not obtained, the bank will not give you the loan. And it doesn't mean that you no longer owe the auditors. The auditors did the work, and out of what they did, they gave you a certain opinion, an opinion that the bank does not want. So that must still be paid to the auditors. Hence, volume 3, volume 14 and 15 are important so that we understand the issues that relate to small business auditing, so that by the time you get into your entity being audited, you understand exactly what to expect and you understand exactly what your responsibilities are. So we're excited about that volume 3 as well, because it's going to help us to go forward up with that. Okay, because there are a lot of instances where there are disagreement between auditors and the business owners. I think most people don't understand what auditing is and what auditing is all about and what it seeks to do. They only know one thing, that when they want their audited financial statements to be audited, they must be audited and they must get a good report. So it doesn't work like that. So we'll deal with it when we deal with volume 3, 14, and 15. What are the silent killers of your loan application? So when you make an application, sometimes some of the bank will notify you that your loan application has been received and it has been considered. So at that time, they are working on the system, they are dealing with other factors. So there is a difference in giving a loan or in considering a loan application to someone with no credit history as compared to someone who has got a credit history. Although sometimes banks may give loan to someone who has got no credit history but has got good financial position, we have found out that once those people start getting into a loan bracket, they never go out and they mess up their financial potential. So be careful of that. Okay, it doesn't mean that because you don't have a credit history, now you are taking a loan because you want to improve your credit history, you must spoil your affordability to a point of no return. So be careful when you are doing that. Okay. So the loan itself, the application of the loan is not the starting point of the loan application. The starting point of the loan application is to understand your business and to have proper record keeping, so that the information that is there talks for yourself. If you can't get your loan, that's it. That's the best you can do. What we don't encourage is for people to go and cook their books for purposes of getting a loan. All right, that might get you into a serious problem because it means you are not consistent. Erratic bank activity. Ah, the, people don't keep a separate expense, uh, so they don't separate between the bank card of the business and the personal expenses. So banks are very careful with that one because it spells out signals of instability. So be careful on how you do that. So if SPPSA is going to help you to deal with all of this and to deal with the supporting documents that are needed for your entity, but you must be honest in dealing with those ones. So SPPSA is for entities that want to grow, for entities that want to do the right thing at the right time, and people who want to be assisted with record keeping. So some of the things that you might want to do in the missing paper trail is to consider electronic filing. You may consider information. So your information must be correctly at each time and must be packed for it to be available at all times when it is needed. It must be understood the impact the information has in other users of financial statements. The application must be done before you go to the bank. In other words, you must be able to assess your situation if you can qualify or not, so that by the time the bank says to you you don't qualify, you are able to ask why you are not qualifying. Because based on your records, you can afford this, you can meet these obligations and all those things, and they will apply and they will answer you to those ones. The information, if it's correctly packaged, correctly available, may help you to do a proper demand analysis about how much can you exactly qualify for in your loan. So having things like proper bookkeeping personnel, document management, and having information continuously and available, packed nicely, stored safely, stopped for accessibility wherever you are, helps you not to cook your books. Okay, so lending here must be based on your potential, not on the fraudulent financial statements that you may want to give. So excessive personal debt. We let us encourage people to find other ways of financing their debt than to get into loans and messing up with their credit record and find out you've got lots of financial enemies. All right. So if you develop a right habit from the start, we will be able, there is no doubt of us helping you going forward. All right. But it all depends on the attitude that you are giving, the amount of effort that you are giving to your business, and the relationship that you have with your accountants and SPPSA. We have now talked a little bit about the secured and unsecured lending, and we separated between the two. At the end of it, we mentioned that there is nothing called unsecured lending. We mentioned why that lending is secured and what are the banks or financiers using to secure that lending. Quickly, if you want to separate between the two, you will find that secured lending is backed by collateral, which is either your house, car, or property, which may be a problem if your spouse doesn't want you to take the loan, especially on instances where you are married in community of property. So because the loan is backed by that property, the interest rates are normally low, okay? And the amounts that are given are normally larger because there is a big value of assets that you have on your disposal. However, the process to approve the loan takes longer because there's a lot of things that needs to be done to verify how much the assets are worth before the loan is provided. And what we have picked up is that you sometimes banks don't want you to give them business as the collateral to say no, you can take my business if the loan is successful, because they know that you are the only one who understands how your business works. So it can immediately fail, or you can go somewhere else and open the business and start with it. So maybe you may ask yourself why business cannot be a collateral. Okay. So by taking a secured loan and pointing out the assets as collateral, you are giving the bank or a financier an opportunity to seize your assets if you are defaulting. However, if you don't want that and you need the money, you can take the unsecured lending. So there is no collateral and there is no spouse that is needed for you to take the loan. They check your business credit worthiness and your individual credit worthiness. Because there is no collateral, you will find that there are high interest rates there. Because you are agreeing to this and you are showing signs of being a better payer. So what is nice about unsecured lending is that you get in there, you make an application, you go with a loan. All right. But sometimes these are typically small amounts to businesses, but to individuals, these are normally very, very big amounts. So you can get that amount there. So what we have noticed is that some of the small businesses are normally very fresh. They are not dating far back, and they would normally qualify for secured loans because they don't have assets and forcing them to higher interest rates. It's even worse when the director is not employed somewhere, because then they can't even be surety or a guarantor, and the person may end up not getting the loan. Yeah, I remember when we started our firm, we couldn't even get a printer, to print. We could not buy a printer, of course, for a number of reasons. It's always difficult to buy an electronic appliance. It was a struggle to get a printer. It was a struggle to get an office because we didn't have any business history before. We had no suppliers and all of that and all of that. Fortunately, there were people who helped us. We got our printer from Intech, yeah, iTech, yeah. Oh, those guys helped us. You will be amazed about how many people offered us printers 3 months, 3 years after that. Some of them even saying, even if you don't pay for 6 months, we can give you the printer. But that 6 months, the 6 months that we wanted when we started, we don't want it now. And all those things. So it's really difficult. The issues with rent, getting a space in time, you are not in town, you are not known, and all those things. So there can be really a lot of challenges when you start a business. I can agree with the authors of those slides. We've already talked in our previous sessions about the guarantees and the guarantors and the sureties. But what we can say is that both instruments require careful consideration, as they can have serious financial consequences for individuals providing them. Banks may require personal balance sheet, so hence you must always have a legit and correct balance sheet, letters of drawings from the directors who do not have a fixed salary, and 834 from SARS that is going to correspond with what you are saying to the bank, and the budget detailing your living expenses. This can be also be obtained from the surety and from the guarantor as well. So just make those people aware that this is what will be needed from them in case you want to approach them. So what we have seen is that people don't understand these agreements. That is the dangers of surety agreements. Okay, and people normally use their emotional thoughts when they get to this, and they don't want to disappoint the persons who are looking for these things. These can be very, very dangerous, and immediately when you get to those, you must ask yourself a number of pertinent questions. Okay, first you must understand what you are signing for and why the person trusts you so much. Okay, so the aim of the bank here, they just try to get a list of people who will make sure that their loan is getting paid. Okay, so the debt with surety or guarantee does not vanish, but it shifts from one person to another up until it's fully paid out. So this is another way for the lender to ensure that they recoup their monies even if the principal obligated person is no longer there. So that is the aim of this. So you can say that these instruments are used by banks or institutions that don't have they've got very strong credit management practices, because you can see that they don't want to lose. Okay, so you must be asking yourself these questions before you get into surety. Will you be able to repay their debts, this person's debts? What is this person to you? Why are you getting into this? Have you fulfilled the risk or return verbally? Take this information to your lawyer for verification so that your lawyer can assist you in pointing out some of the things the person did not mention to you. Have you shown your business weaknesses, not just your vision? So what we're saying there is that most people often do not want to carry true financial records to the bank because they don't want to ruin the possibility of getting the loan. They'll rather reinvent the financial information so as to increase the chances of getting the loan. But remember, the banks themselves have been in this game for longer, so they've got an understanding of what information of your age, of a business of situated similar to you, must look like. Is this person's life stable enough to survive if your business collapses? So the person who is coming to you for surety, just look at the person's circumstances and decide unconditionally whether you are giving the surety signature or not. And also decide whether you are doing this out of love or as emotion or out of a business decision. Look at it and find out what is it for you to do this. All right, is this your child? Is this your wife? Is this your uncle whom you've always wanted to succeed? Is this the only is this the only possible arrangement in which this person can succeed? So those are the questions that must be answered. So you get to the personal balance sheet. So the lenders will also want the personal balance sheet to for you to back up your financial statements. Okay, so it reflects your true financial positions and answers a few questions like, if everything went wrong today, how could you survive? I can put in my assets to do this. Okay, so there are basic things that you must ensure are there. But what I found is that once a lender has seen an opportunity to give you a loan, and you have submitted a personal balance sheet with errors, they will ask you to correct it, and they will give you indicators of where to correct. But basically, it must have a few things. It must be prepared. Excuse me. It must be prepared by the FIP. Sorry. So it must be in the FIP's letterhead. It must be of a particular date because the information that is there is changing frequently. It must have an accurate address of the person owning the assets in the personal balance sheet. It must be verified. So some of the lenders will also ask you to reduce to also support the personal balance sheet by an affidavit where you confirm that you have went and seen these assets, because they are not going to do that. So it's a form of emotional audit to say, you commit yourself. And most FIPs would not want to commit themselves to something that they did not see, and you wouldn't know really what are the implications of them asking you to do this audit. In other words, what will happen to you if this loan fails, the client fails to pay this loan, and eventually it comes to light that these assets do not exist, and you've already committed yourself that you have seen it. Okay, so the proof of each asset is talking about is talking about documentation management. We would like to encourage people that even the things that they buy separately from one for themselves, those things must have a proof that this is what I bought, this is when I bought it at this particular point. It's not an easy task, but if you are encouraged enough to start up opening up a file where you're gonna put your things there, it's gonna work very well. But what is important, we've always encouraged that people must open up an electronic file, okay, whether on a Dropbox or in an email or whatever the case may be. Because if you put up a physical file at home, you'll find that the slips there, the information there is no longer clear because it vanishes with time. So there are some of the things that you can do, especially for cars, where you take the car and to the dealer for verification and the price is given. The property, you can get the valuation from the municipality at where the property is. But sometimes some people will want their own valuers. If you are the member of the fund can send you a fund value certificate that shows you how much the fund is owing you, how much that can be given to you should you decide to take your money. If you've got fixed assets, market accounts, money market accounts, 64 days accounts, you can draw statements from there and you can verify that information as well. So if you give loan to other people, if you've got apps and all those things, you can give that information to them and say, I've got this app is generating money for me. This is how much from my bank statements this app is giving me as well. So those are the things that you can do to show to the bank. So you can see that the emphasis is not how much you have, but the emphasis is more into how much you can prove. Okay. So in addition to the balance sheet, the lenders can also ask the letter of drawings to say how much have you been drawing from the company, and what is the total of those drawings. The requirements are the same. The letter must be in the FIP's letterhead. It must be written in a particular date. The information must be verified with the client that is accurate, and so forth, because the information is in the bank statements. But we must emphasize that the client must disclose to us whether he has got one bank account, because you'll find that the drawings are different when the bank accounts are different as well. So we must confirm the bank account in which the letter of drawings was drawn. Okay. So the best practice, just go on and pay yourself a fixed salary from the business. Separate your personal expenses from the business expenses. In other words, don't use the business bank card to swipe for food, groceries, petrol, and all those things. Just school fees, just pay yourself. So if you need 2,000 rand, just transfer 2,000 rand to that side and spend it that side. Okay. uh, all the drawings that you are taking, note them so that it's easier to find them and it's easier to edit them up. All right. So don't always take large drawings because money is available. Always take money for purposes of checking it, but stop taking drawings if your company now can afford a fixed salary. And if you afford a fixed salary, make disciplined actions and say, from this fixed salary, this is what I'm taking from the business. If I finish this money, I'm not going back to the business. I'm gonna go and take a loan to subsidize my standard of living. Or if I'm taking a loan from the business, I'm taking a loan from the business, and this is the rate of interest that I'm gonna pay. All right. I'm going to pay it back to the business. Okay. So a personal balance sheet, we must also do a budget, because the financier might want, together with the letter of drawings and together with the personal balance sheet, to say how much do you spend monthly, where is your money is coming from, where is your money is going to. They just do this also to see, with the loan that they are giving you, is there a potential of seeing some of the expenses getting cut? How rigid are your expenses? What expenses can fall off because now you've got a loan and so forth. So that's why that one is important, and you are encouraged to get into SBPSA for you to check some of the things that we do, and for you to get into our CPD and to be a better person. But of course, you can always watch online for your own benefit. So to join SBPSA, you can visit us in our website. Membership is always available, and we really encourage people to be part of our society so that we can address these issues together. So we have picked up now that there are a number of silent killers that sink the small business function, the small business entities. So there is normally no clear financial history. People are taking money as and when they want the money from the business because it's available. People don't have a personal budget so that when the business is financing them, what is it exactly that they are financing them? They are getting into wrong arrangement like guarantee and surety arrangements. When they do applications, the applications are rush and are not planned for. And generally, the manner in which things are done is an adversarial approach to them and is not a well thought of. So it is very important to understand that there are other institutions that may help you to get your things right and to do things properly going forward. Remember, there is always a chance to do things right. All what is important is discipline and to take corrective actions and determined actions that you want to belong to societies like SPPSA, where the majority of people want to do things right and to grow, and where you see the value of your growth and where the growth and shortfalls are explained. Thank you so much, ladies and gentlemen. So we are done now with cycle 2.2 CPT. Then we're gonna go to sub cycle 2.3 CPT. That is gonna be dealing with suppliers of goods and services and company employees. So you can see that we are doing all this effort to ensure that at least you understand the information. So that's why we've broken it into different parts, and you are able to conceptualize it and contextualize it and comprehend with it. All right, and you are able to ask us questions that you feel pertinent to your circumstances. Thank you so much. I will be meeting you now in the next session.